Welcome back, everyone. Today on the Joseph Carlson Show, earnings season is underway, and we had some of the biggest companies report earnings just yesterday. Microsoft reported earnings. It's down slightly, just a hair, but we're going to look overall what's going on with Microsoft. How is this company doing, and is the intrinsic value of the company going up or down? Google also reported earnings, and it's having a bit of a sell-off, down 6% today. The headline is that they had disappointing ad revenue. Now, we're going to be looking at this data point and seeing how big of a deal this is, but we'll also be looking at Google holistically as a company. Is this company moving in the right direction? Are all the key metrics growing in value or shrinking in value? After Google, we'll be looking at Mastercard. They just reported earnings today. The stock is up 1% on the day while the rest of the market's in the red. But I'll be breaking down the key metrics of this company and what I track as an investor in it. Another company I keep track of are the railroads, Canadian Pacific. They just reported earnings and the stock is up 1.5%. This is a company that I think has a lot of potential. I've been bullish on this one, but it really hasn't had a lot of momentum over the past year. So I'm eager to see how things are going with Canadian Pacific. And then finally, we can't forget about Starbucks. I've had this theory going on for a while that we're in a bit of a caffeine bubble. There's so many companies trying to create caffeinated beverages, and Starbucks is the leader of that pack. They're the ones that sell the most caffeinated beverages to the most people. I also use this company as a gauge for how fast food companies will do. So I'll be looking at Starbucks and seeing if we can draw any conclusions from this most recent report. So we have a lot to get to in this episode. We're going to be breaking down all of these earnings reports. Let's go ahead and start off with the biggest one, which is Microsoft. Now, with every company as big as Microsoft, there's a lot of news that covers these companies. A lot of sources like CNBC and other news outlets that try to direct your attention. They try to grab your attention and then determine what you should focus on. Microsoft issues light guidance, even as Azure growth drives earnings beat. So there you have a headline that's a bit mixed. They're saying to focus on the light guidance ahead. We have the Wall Street Journal saying that Microsoft earnings jumped as AI demand boosts cloud unit. So now we're jumping from the light guidance to the AI demand. From Barron, Microsoft Alphabet fall foul of great expectations, but Apple may not. These are all the different news outlet takes, and they do the same thing on TV. Everyone has their different perspectives of what is the main focus for a stock, and this can become very confusing. It's easy to become overwhelmed with the various amounts of news and takes and opinions on a stock, and it can become distracting from the main intrinsic value drivers of a stock. But every single company, whether it's Microsoft or whether it's Best Buy, whether it's Dunkin' Donuts, it doesn't matter what the stock is. If it's a stock, there's a couple key indicators that really determine whether or not the company's progressing or going backwards. In my last episode, I came out with an investing philosophy presentation. This is completely free. You can download it in the description. But on slide 7, I talk about the intrinsic value drivers of a company. Out of everything that you can focus on, every single aspect of a company, the intrinsic value boils down to a couple key ingredients. The key drivers of intrinsic value are first, organic revenue growth. If the top line is growing organically, meaning without the need for acquisition. Next is free cash flow per share growth. That is a profitability metric that I track for every company to see how it's progressing. And then finally, predictability, either maintaining or more preferably improving. Predictability means that the company has a wider moat, better market share. It's more predictable today than it was a year ago. Simply put, if these three metrics are improving, the company's worth more intrinsically. If these three metrics are going down, the company is worth less intrinsically. So having said that, let's go ahead and jump into Microsoft's report here. We have the fourth quarter. The revenue increased to $62 billion, which was up 16% on a constant currency basis. This is a bit faster than usual because they did the Activision Blizzard merger. So not all of this is organic, but even taking that out, this is very fast revenue growth. Microsoft is growing revenues steadily above 10% per year. In the past 5 years, they've grown at 14%. That's been driven in large part by the explosive Azure growth, especially in combination of AI. And I expect that to continue, but slow down slightly. I think 12 to 13% is accurate. Now, the CEO of the company, Satya Nadella, wants you to know that the main drivers of this growth is AI. We've moved from talking about AI to applying AI at scale. That's a key sentence. Microsoft is not just talking about AI as a buzzword. They're actually making money with AI, and that's an important distinction. The other main highlight they have for us in the earnings report is the cloud growth. Microsoft Cloud revenue grew to $33.7 billion, up 24% or 22% on constant currency basis. So you have strong cloud growth that beat analysts' expectations, which was good. Now they said that they gave light guidance on this, but a beat is good enough for now. So we know that the revenue was good, we know that the company's growing their cloud, now we can move on to the cash flow statement and see how much cash this company's generating. We calculate the free cash flow of the company by looking at net cash from operations. This was $18.8 billion in the quarter. Their investing expense of property and equipment, which is CapEx, was $9.7 billion. That leaves us with around $9 billion. And when we bring that up on Qualtrim, this is what it looks like visualized. $9.12 billion to be exact. This is the free cash flow number of the latest quarter. Now, if we factor in stock-based compensation into this free cash flow profile, we can see that they paid $2.8 billion in stock-based comp in the most recent quarter. And we can see that side by side right here. $2.8 billion against the free cash flow of $9.12. For Microsoft, the stock-based comp is not the biggest deal. It makes up around 15% of their total free cash flow. Overall, this is a very strong free cash flow profile. It is growing over time at a steady cadence. So again, overall, when we're looking at Microsoft and we're trying to answer that question of whether or not the intrinsic value is increasing or decreasing, we look at these three metrics, and I see all of them moving in the right direction. You look at the latest quarter, and the revenue's growing. It's growing right in line, and most of this is organic growth. Microsoft has a very strong top-line revenue growth. It seems like it should slow down because the company's so big, but when you really think about it, Microsoft is more of a lot of small companies than it is one really big one. CNBC gives this nice little visual of a breakdown of all the different revenue items of Microsoft. And they have Azure, Dynamics, Office 365, Office Commercial, Office Consumer, Search, News, Advertising. Remember that they own LinkedIn, GitHub, they own Xbox, all of these different products. So a lot of investors are dissuaded thinking that Microsoft is so big that the revenue growth will slow down. But what they've shown is that they're more of an ETF, a collection of many smaller companies combined under one umbrella. Most of that revenue gets funneled up to the cloud services. But don't be mistaken, Microsoft is a vast and powerful company that has its hands in many different businesses, most of which are growing around 10% or more. And the biggest ones, the most important ones, are growing above 20%. So does Microsoft still have this nice organic growth? Yes, they do. Is Microsoft's free cash flow on a per share basis increasing over time? Yes, it is. Very clearly, the free cash flow is growing over time. We see these trends year after year, and I don't see anything with this most recent quarter to throw this story off. What I see is a continuation of free cash flow growing on a per share basis. And then finally, can we argue that Microsoft is less predictable today than it was a year ago? I don't think so. I think if anything, Microsoft is even more predictable and has a wider moat today than it was a year ago. It is a bigger moat company than it was last year. The company has solidified its position as a top cloud leader. They have solidified their position to a point where nobody can disrupt them. Amazon may still be the biggest, but Microsoft is one of the largest players now for sure. And that is a moat that's going to be incredibly difficult to disrupt. When I look at Microsoft, I believe the intrinsic value of this company has increased around 15% over the past year. The stock price has raced up much faster than that, but the intrinsic value is increasing. And even though the valuation is a little higher now, I'm still going to hold Microsoft in my portfolio. Now moving on, we have to talk about Google's report. They reported earnings and they're giving up some of their gains this year. The company's down 6.5% on the day. Year to date, they're on a roll, but now they're up only 2.6%. Now, Google disappointed investors with these results. Before I dive into it, I first want to look at an investor that covers this stock called Mark Mahaney. Mark Mahaney is a growth investor. I think he's really good, and I want to hear his opinion on why this stock is selling off today.
The results came in better than expected, but not from search revenue and not from YouTube revenue. And there were a lot of expectations chatter in the market that both of those were very strong going into the holiday. So expectations were high there. I don't think there was a dramatic miss, but this was a high expectations part quarter. Where they did positively surprise me and some other investors, but definitely me, was their margins came in better than expected. There's a $1.2 billion charge. You take that out, margins were very solid for the company. I give them credit for that. My guess is that overall, numbers will probably go up on the street on these results. But yeah, the expectations were high on the advertising. side, and they just met them. They didn't exceed them. That's why the stock's pulling back.
So his thoughts on the sell-off were simple. Expectations going into this quarter were relatively high. Google just met those expectations. They didn't exceed them. So the stock is cooling off and taking a breather. Now, he goes on in this same interview, I believe, to highlight the key issue with Google, the key thing that investors really want to hear.
But there was a cost religion memo that went around Silicon Valley, and it almost seems like Google sent it back. I'm being too critical when I say that, but what the market would like to hear is, will you make a commitment to running your OPEX growth at a lower level than your revenue growth? Like i.e. expand margins, and the company's not willing to do that. They have a lot of good reasons for not doing that, but in this day and age, companies get rewarded for really managing much more aggressively their costs. That's what happened to Meta this last year. It happened to a good number of other stocks, Amazon too. So the market's willing to reward real, good cost discipline, more aggressive cost steps. And it doesn't seem to me, I listen to that language, it's the same language that Google has made over the last, couple of quarters. There's nothing wrong with it, but it's not what the market really wants right now.
Investors are looking for Google to run the company with better cost structure, more care over their OPEX spend, more care over how many shares they're issuing and what they're doing in terms of CapEx. And Google has been very reluctant. In fact, they've been almost refusing to do that to the same extent as any other company. Mark Zuckerberg, for example, committed to the year of efficiency. This is what caused Meta stock to explode over the past year. The efficiency of growing margins, having the revenue grow faster than expenses. Netflix had the same event happen over the past year. They grew revenue without growing expenses, causing margins to increase and the stock to outperform. Now, this isn't all bad. Google's not quite as efficient as other companies. They haven't done the year of efficiency quite like Meta, but they are growing nicely, and this report was a good quarter. I believe Sundar Pichai was also great on this earnings call, especially addressing some of the key concerns that investors have. For example, right at the very beginning of this earnings report, he says we are pleased with the ongoing strength in search and the growing contribution from YouTube and cloud. I believe the reason that he first highlights the strength in search is to calm investors' concerns about search being a weak moat business that's going to be taken over by large language models. The way that he talks about this is that they've always faced a lot of competition in this area. Google has always faced different ways to get information. So they're not new to this. They're not ignorant about competitors, and they've done this thing a time or two. That's the way that he sort of talked about it on the earnings call, and I thought that was great. And he highlighted, more importantly, that search is benefiting from AI investments. It's not getting weaker, it's getting stronger. Now, on the earnings call specifically, he mentioned that AI in combination of search will lower the latency of search by around 40%, making search faster for everyone, a better product. He also said that AI with search will address one of the biggest weaknesses of Google search, which is complex questions. AI will allow Google search to answer even more complex search questions, which will make it have a bigger breadth of value to the customer. So the thing that Sundar Pichai is trying to do this quarter is say that search is not only not in trouble, but it's actually getting stronger. The moat is growing. The strength of search now, relative to a year ago, is a wider moat, not a weaker one. Now, you can argue with this, and I'm sure there's people that disagree, but I tend to believe them. Most people are addicted to using Google search, and AI has the ability to make it faster and much more powerful. Now, the CFO of the company highlights the revenue growth. We ended 2023 with very strong fourth quarter financial results, with Q4 consolidated revenues of $86 billion, up 13% year over year. Here we have another company that's worth north of $1 trillion that's still growing revenue by 13% year over year. It's just incredible to see these large companies grow this quickly. And this is organic revenue growth. Google does minor acquisitions here and there, but those aren't really substantial. The majority of this growth is due to organically growing their products and services, reaching more customers, and by pricing power. What I see from Google in their top line is a continuation of their very long history of having an incredibly strong organic growth profile. If we look at a breakdown of their key services and see how these are growing individually, it shows that each individual part of Google is also growing at a steady pace. We have the primary business, the search business here, which had very strong growth year over year, $42 billion to $48 billion. I like seeing that. YouTube ads, $7.9 billion to 9.2. The next one's Google Cloud, which went from 7.3 billion to 9.1 billion. This beat out Wall Street's estimates, so Google Cloud also showed strong growth. I like the growth profile of Google. All their core metrics seem to be moving in the right direction. Now, to determine the profitability of the company, we're going to be looking at their cash flow statement and looking at the free cash flow. We're looking at this column right here, December 31st, 2023, quarter end. If we look at the net cash provided by operating activities, this was 18.9 billion. Now, looking up from this, we can see that there is a one-time income tax hit. They deferred it until this quarter, so you have to just keep that in mind. They have a $9.8 billion tax hit, so that's artificially lowering the amount of free cash flow they generated this quarter. Now, the purchase of property and equipment has ticked up a lot year over year, and this is something that investors are a bit concerned about. It went from $8 billion to $11 billion. But Google says they're investing in new server farms, new CapEx for their cloud hosting, which I believe is a worthy investment. So I'm not too upset about the uptick in CapEx. Let's bring up the chart here and see how it looks on Qualtrim. This is what it looks like with the last quarter, $7.9 billion, which brings you all the way back to the same cash flow level in 2020. So this seems a lot lower at first glance, but remember that one-time tax payment was almost $10 billion. So this would more accurately be, if you took out that tax payment, around $18 billion in free cash flow. It'd be right around here. Of course, taxes are a real expense, so this is their free cash flow, but just keep that in mind. When we zoom out a bit and we look at this on an annual basis, we can see that Google's free cash flow is growing nicely. We have organic free cash flow growth. The free cash flow per share is growing nicely over time. Over the past 5 years, it's grown at an astounding rate of 27% per year. That is super fast free cash flow per share growth. So with Google having the strong top-line organic revenue growth, having very fast free cash flow per share growth, and the moat of the company being proven to be more resilient and stronger than investors have feared, I believe that the company's intrinsic value has increased by around 20% year over year. That is my estimate of the incremental increase in value. Now, Google stock has gone up more than 20% over the trailing year. In this case, I think it's fine for Google to trade flat for a little while, to get a little bit of a breather. Over time, the intrinsic value should continue to increase, and so should the stock price. But like a lot of these companies, the stock price has raced up much faster than the intrinsic value. So I'm fine if this company takes a bit of a breather. Now, next up, we have Mastercard, one of the largest positions, a top 3 position in my portfolio, and they just reported earnings today. Mastercard is such an easy company to hold because it's simply so predictable. Their earnings were a beat on the top and bottom line. The company's up 1.36% today after being up 7% year to date. So we're having a good year with Mastercard and everything's on track. Fourth quarter net revenues grew to $6.5 billion. That's an 11% increase on a currency neutral basis. So very strong top line revenue growth year over year. And then we have some comments from the CEO. We delivered strong earnings and revenue growth in the full year of 2023, driven by healthy consumer spending, cross-border volume growth of 24%, and solid execution of our strategy. Now, one thing that investors get wrong frequently from Mastercard and Visa is they believe these companies issue credit cards. They do not issue credit cards. They partner with banks, and the banks are the ones that deal with the customers. Banks issue credit cards on their behalf. They say that in the fourth quarter, we signed the third U.S. regulated bank debit portfolio to flip to our network within the last 12 months. So they're signing up additional banks, and those banks will go up and sign up additional customers to join the Mastercard network. That's the way that this company grows. As they grow the amount of banks in their network, they grow the amount of customers in their network. Banks love Mastercard and Visa. They absolutely love these companies because they make a lot of money with credit cards. So this is an incredibly strong and unique moat for a company. They're set up with working with the banks and working with merchants, growing their network that way allows for continued very strong growth for this company. Now, they also offer a lot of different products besides just their card network. They also have a range of unique, diversified products and services to solve customers' needs. So they don't go into it in great detail there, but around 20% of their revenue comes from value-add services like identity verification, knowing your customer, fraud detection, information on sales trends. All of that type of stuff can be sold to these customers to add value to their products. And that's a fast-growing portion of Mastercard's income. So we know the company's growing their top line organic revenue. That's a check mark. We also know that the company's moat's getting bigger as their network grows and it becomes more difficult to compete with them. Now we have to look at the profitability of the company. We can gauge that again by the statement of cash flows. And this is where Mastercard really shines. We have here the entire year for Mastercard, and we'll look at how efficient this company is. It's really incredible to see. Right here we have the net cash provided by operating activities. This was nearly $12 billion, 11.98. Now, if we look at the amount of CapEx they do, purchase of property and equipment, this isn't a typo, this is real, 371 million. Again, compare that against Microsoft, Apple, Google, Meta, any of those companies, and this is dramatically less by proportion. This company, like Visa, is a uniquely efficient money-making machine, so they don't have much CapEx requirement. Now, the other big problem with a lot of these reports is the amount of dilution these companies do. Again, this is not a problem for Mastercard. $460 million of dilution in the entire year. So their stock-based compensation is minuscule to the amount of cash flow they generate. Truth be told, Mastercard and Visa are simply in a league of their own. There's no way big tech will ever become anywhere close as efficient as these companies, nor will most companies on planet Earth. They are very unique companies. I can't find many others like them. Now, when I look at their free cash flow, that brings their total free cash flow for 2023 to right around $11 billion. So a nice continual step up year after year. And their free cash flow per share continues to grow right in line, just as you'd expect. The organic revenue has grown. The free cash flow per share has grown at a steady pace, and the moat is bigger than it was a year ago. I believe that the intrinsic value of Mastercard has increased by around 15% year over year. Next up, we have Canadian Pacific Railway, which just reported their earnings yesterday. This is another one of my holdings, but I've only held this one for about a year and a half. So it's a relatively new holding, and we're just starting to see some signs of life. The stock is up ever so slightly. I'm in the green by $1,500. I think the best way to look at the progress of Canadian Pacific is through their earnings presentations. They put together some really nice presentations that illustrate what's going on very clearly. They've gone through a recent merger which throws off a lot of the metrics, and this can make it more confusing to decipher what's really going on, but they break it down here very clearly. The revenues grew by 42%. But that includes the merger, so that's not organic growth. If we factor in the merger and we look at the total combined revenues, it was 5%, which is much more reasonable. That seems on the low end, but railways typically don't grow by 12 or 15% per year. They're a little bit slower growing, but they're very efficient and they transfer a lot of that growth into profitability. So 5% growth is fine. It's fine for the state that Canadian Pacific's in. The next thing is the core adjusted combined diluted EPS. Earnings per share were only up 2% year over year, which is by far the slowest earnings per share growth of any company in my portfolio. The main reason that their earnings per share grew so slowly this quarter is because of expenses related to the acquisition that are not long-term expenses. So this is a unique case where this 2% growth is not indicative of their longer-term growth potential. So again, this is a more difficult one to look at because going through this merger throws off a lot of the short-term metrics, but their outlook remains intact. Capital expenditures of $7.5 billion. They plan on holding that steady for the next 5 years while growing revenue, which will increase their operating ratios and their margins over time. They're also forecasting high single-digit revenue growth, double-digit core adjusted combined EPS growth. So that's double-digit EPS growth after the combination of the two companies, and combined free cash flow conversion of 90%. Now, if you combine all of this together, their growth expectations with their earnings per share, with their free cash flow conversion, you get a free cash flow per share growth of around 20% per year for the next 5 years. If they're able to achieve that, that'll be very, very strong economic growth for this company. So right now, Canadian Pacific's in a state of flux, but I'm going to give this one another year to prove itself if it can start meeting its metrics. If they're able to meet these metrics, then I'll continue to hold the company, but if they're not able to, if they fall off from their goals and they revise them lower, then I'll end up selling this company. Now, next up, we have Starbucks. They just recently reported earnings. Starbucks is one of the biggest fast food companies in the world, specifically with their drinks. They've really capitalized on the caffeine addiction that everyone seems to have. Starbucks did not have a great earnings report. That's the simple way of putting it. If we look at the metrics compared against the analyst estimates, they almost missed on every single metric. They missed on the top line, they missed on the bottom line. They missed on the same-store sales, they missed on international growth, but yet the stock is not being severely punished. The reason why is because the stock is relatively cheap. Starbucks is still at $93 per share. This is a company that's been around that price point for quite some time. If we go back to a year ago, it was trading at $110. So it's just been in this phase of trading around the same territory for a long period of time. So even though it had underwhelming results, it didn't meet up to investors' expectations, it did not get punished. And that's a good thing for investors in the stock. The net revenues were up 8%. That's relatively slow growth. I want companies that can grow above 10%, but 8% is okay, especially if it's just on a quarterly basis. Comparable same-store sales were only 5%. That's not fast same-store sales growth. Companies like Chipotle and Texas Roadhouse have been posting much faster same-store sales growth than 5%. So this is the problem with their earnings report. These numbers are a little bit weaker than expected. Now on the bright side, their active US members for their app is now at 34.3 million. So they have an incredible number of people using the Starbucks digital app, uploading money to it, which Starbucks uses as a bank with free loans. So that works out really well for them and also brings in loyalty from their customers. So I like seeing this as a key metric growing over time. Now, if we look at the profitability of their company this quarter, we can see the net cash provided by operating activities at $2.38 billion. We see that the additions to property, plant, and equipment, which is their CapEx, was $595 million. That's a combined free cash flow of $1.79 billion in this most recent quarter. Now, looking at this over the past 5 years, it doesn't look like it's that much of a convincing trend that it's growing steadily over time. It's still good, the company generates free cash flow, but I'd like to see a more steady trend of free cash flow per share growth. Now, the moat of Starbucks is questionable. You can believe that it's very strong because of their brand value and their digital app. They have a big consumer loyalty, but there's also a lot of companies going into the caffeinated beverage market. For example, McDonald's is moving into that category with their Cosmics. So they do face a lot of competition. So overall, when I factor in all of this, the organic revenue growth, the free cash flow per share, and the moat of the company, I believe Starbucks' intrinsic value grew at around 8% last year. So it's been a busy week so far, and we still have earnings reports upcoming, with Amazon, Apple, and Meta all reporting tomorrow. So make sure you subscribe to the channel and my other YouTube channel where I'll be covering those earnings results. That's all for now. See you in the next one.